Last week, the Federal Reserve reduced its number of planned interest rate cuts amid fears of tariff-driven inflation. We'll examine the implications for consumers, reverse mortgage borrowers, and others right after this brief message.
Building relationships is the way Mutual of Omaha has grown into one of the leading financial services companies in the world. Our reverse mortgage wholesale division is proud to carry on this 100-plus year tradition. To your borrowers, a reverse mortgage is more than a transaction. It's a promise of a better, more stress-free life. Our goal is to provide you, our valued client, with the best service and support possible so you can focus on helping your borrowers achieve the retirement of their dreams.
Welcome and thank you for joining us. Before we dive in, I want to let you know that next week, we haven't forgotten, we'll bring you part 2 of our exclusive interview with the nation's top producing reverse mortgage professional and originator. That's George Verban. You don't want to miss his insights as both an originator and also as a reverse mortgage borrower. So tune in next Monday. So today we're going to unpack the Fed's big announcement from last week and how their decision to slow the pace of future rate cuts could impact the reverse and traditional mortgage lending space. Fed Chairman Jerome Powell's remarks began on an upbeat note, but it didn't end that way. In fact, his closing left, quite a few Wall Street analysts scratching their heads. Let's see how it began.
Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment.
It sounds promising, right? Even bullish, like perhaps the Fed would accelerate the pace of rate cuts. Well, think again.
It takes some time for tariffs to work their way through the chain of distribution to the end consumer. A good example of that would be goods being sold at retailers today may have been imported several months ago before tariffs were imposed. Every forecaster you can name who is a professional forecaster with adequate resources and forecasts for a living is forecasting pretty significant. Everyone that I know is forecasting a meaningful increase in inflation in coming months from tariffs because someone has to pay for the tariffs.
Yes, they just walked back several of their previously planned rate reductions. Now, just last December, the Fed had projected 2 rate cuts in 2026 and 2 more in 2027, an aggressive pace. But now they're only projecting 1 cut in each of those years. Why? Because the Fed is concerned that tariffs could slow GDP growth while pushing inflation higher. And that's a tough combination, and it's making the Fed even more cautious. The bottom line is we're unlikely to see any meaningful drop in consumer, commercial, or mortgage rates until later this year, if at all. And I say if at all because last week's meeting was a reminder. The Fed's looking glass cannot see the future. They're only looking at lagging data. And consequently, their choices are often fluid and reactive. In fact, Powell used the word uncertainty 6 times in his prepared remarks. He called out things like trade policy, immigration, fiscal concerns, and regulation. But before we continue, I want to thank you for liking, sharing, and subscribing to these videos. It helps us more than you know. And don't forget to subscribe to HeckhamWorld.com for all the latest reverse mortgage insights and analysis. Today, Wall Street is scrambling to decode just what's really behind the Fed's shift in policy. While unspoken, it's the S word, stagflation. That's the rare and nasty combination of rising inflation and slowing economic growth. And we haven't seen it since the 1970s during the OPEC oil crisis and some questionable monetary policies. To be clear, inflation today is nowhere close to the 14.5% peak we saw back then, but it's still just right above the Fed's 2% target. Headline PCE inflation eased from 2.5% in January to 2.1% in April, which sounds good, but remember, the Fed is working with lagging data, 2 months behind in this case. And that lag makes it riskier to act. If you cut rates too soon, you could reignite inflation. If you wait too long, you may stall the economy, or even worse, the Fed could cause a recession. In fact, this lagging data has led President Trump to dub Chairman Powell as Mr. Too Late. So what does this all mean for mortgage professionals, especially for those in the reverse mortgage space? Well, we're going to tell you that here in a minute. But the Fed's hesitancy means that interest rates are going to stay elevated in the long term, which will impact everything from forward mortgages and also the federally insured reverse mortgage, or HECM, home equity conversion mortgage. Now, first, sustained rates are going to keep the HECM's expected keyed rate to the 10-year constant maturity treasury elevated, and that will also increase the expected rate, which determines the amount of funds available. The old truism of mortgage lending applies to both traditional and reverse mortgage loans. The higher rate, the lower the consumer's borrowing power. And if widespread or even modest declines in home values are seen in the next year or two, the impact would be magnified even further. And that will add downward pressure to the HECM's principal limit factors, or PLFs. Now, those are the percentage of the home's appraised value that is going to determine the gross loan proceeds available. And that's going to be based on the expected rate and the age of the youngest reverse mortgage borrower. However, beyond PLFs are the more nuanced impacts on the HECM program's net present value and FHA's Mutual Mortgage Insurance Fund. The HECM's valuation is known to swing wildly because it's largely influenced by home price appreciation and prevailing interest rates. And we've seen the slowing or even a reversal of appreciation and higher rates dramatically reduce the program's valuation within FHA's fund. In addition, elevated rates accelerate negative amortization on a reverse mortgage, and that widens the spread between HECM loan balances and home values. And that increases the chances that an FHA insurance claim will be paid. In the final analysis, even critics can agree with the Fed's assessment of uncertainty. And that's something that you, seasoned reverse mortgage professionals, are very adept at dealing with. Now, what are your thoughts? You can leave your thoughts in the comment section below. And also, if you'd be so kind as to share this video in your LinkedIn network. We mentioned our YouTube channel earlier. Be sure to subscribe so you never miss any of our latest content. And each and every week, we bring you the most recent reverse mortgage news on our weekly podcast, HECM World Weekly. We have both an audio and a video edition. Listeners can subscribe and listen on Apple Music and Spotify. Thank you so much for joining us, and be sure to return next week for part 2 of our interview with George Verbin, a reverse mortgage professional who just got his own reverse mortgage. We'll hear more then. We'll see you